So good morning to one and all. Welcome to my YouTube channel. This is Narayan Rao Kovur. Today we are going to discuss the details of primary deficit. What is the meaning of primary deficit? What is the formula to calculate primary deficit? What are the positive effects of primary deficit on the Indian economy? And what are the negative effects of primary deficit on the Indian economy? And what is the keynote of zero primary deficit? These are the details discussed in this video. Now let us examine first what is the meaning of primary deficit. Primary deficit is the fiscal deficit excluding interest payments on the past debts. So that means fiscal deficit minus interest payments is equal to primary deficit. Here, fiscal deficit is equal to total expenditure minus total receipts excluding borrowings. That is called fiscal deficit. Therefore, primary deficit means fiscal deficit minus interest payments. Next, formula. Primary deficit is equal to fiscal deficit minus interest payments. Second one, primary deficit is equal to total expenditure minus revenue receipts plus non-debt capital receipts minus interest payments. So here total expenditure includes revenue expenditure and capital expenditure. What is revenue expenditure? Expenditure incurred for day-to-day functioning of the government, and it does not create asset nor reduce liability of the government. So examples are salaries of the government employees, pensions, subsidies, etc. Next, capital expenditure. Expenditure that creates assets or liability of the government is called capital expenditure. That means purchase of purchase of machinery and defense equipment, construction of dams, railways and roadways, etc. Next, revenue receipts. Revenue receipts are two types. One is tax revenue, another one is non-tax revenue. Tax revenues are income tax, corporate tax, GST, etc. Non-tax revenue are fee, license fee, fine, administrative revenue, commercial revenue, loans and advances, grants in aid. Next, non-debt capital receipts. Non-debt capital receipts are recovery of loans, disinvestment proceeds, next sale of the government assets, small savings, etc. So non-debt capital receipts reduces fiscal deficit, does not increase public debt, minus interest payments. So primary deficit is equal to total expenditure minus revenue receipts plus non-debt capital receipts minus interest payments. Next, positive effects. One is it shows true fiscal discipline of the present government system. Actually, as a result of the primary deficit, it shows true picture of fiscal discipline of the present government system. Second one is it helps assess quality of the fiscal management. What is the quality of the fiscal management? So it assess. Next, lower primary deficit indicates better debt sustainability. Better debt sustainability. Next, these are the positive effects of primary deficit on the Indian economy. Next, negative effects of primary deficit on the Indian economy are it indicates excess current spending. Current spending increases. Second one, leads to higher borrowings in future. If the borrowings increases, as a result of that, borrowings increase in future. Next, public debt burden also increases. When borrowings are increases, automatically public debt burden also increases, and there is a inflationary pressure in the economy. Continuous rise in price level is called inflation. So prices will increase. Next, what is the keynote of zero primary deficit? Zero primary deficit indicates government borrows only to pay interest, not for fresh spending, not for new spending. So these are the basic details of primary deficit. Thank you. Thank you for watching. Like, share, subscribe, and comment.